Hi everyone, welcome to the Real Estate Tax Tips channel. My name is Cherry Chen, a chartered professional accountant located in Oakville, Ontario, Canada. And I'm on a mission to become the Google map for hardworking Canadians seeking financial freedom. And today I have very special guest here with me. But before I get started, if you find our video useful, make sure that you give us a thumbs up and also the subscribe button below. And today's theme is about investing in the single-family home in the United States. And I'm a newbie here, so I wanted to talk to people who are expert in this field who can help me buy my first investment in the States. And we have a very special guest here, Carmen Da Silva, who is also a fellow CPA, CA as well.
Yes.
Yeah, yes. Back in the days, there's only CA,
That's all I
so
knew.
we don't. Yeah, exactly. And also a real CPA. When I say real CPA, it's CPA licensed in the States. So welcome, Carmen.
Thank you. Thanks for having me on.
Yeah, can you tell us a little bit about your investment journey?
Investment journey? Okay, well, maybe I'll go into my background a bit
absolutely.
and then how I got into that. So professionally, I'm a chartered accountant, as you said, and articled at Pricewaterhouse. And that's where you get your tax designation, so the CICA, Canadian Institute of Chartered Accountants.
Yeah, they don't call it that nowadays.
Oh, okay, there you go. That tells you how far back.
I also don't know what it is called today, but it is not called that now.
Okay.
Oh, CPA Ontario. Oh, Canada, CPA Canada.
CPA Canada, yes. So the tax specialist designation, international tax is what I loved.
Yeah.
So pursued that career. But when I got married, it was that balanced life because working at a Pricewaterhouse is like a lot of hours. So I decided to join my family business, which was financial service. And from there, got very involved in tax products. So when I was at Pricewaterhouse, you learn everything about structure, but you don't understand the products that are out there. And at that time, my family was more buy term, invest the difference, and I was being introduced to insurance products that had a TFSA account in the 90s.
Oh, wow.
Really interesting, and the strategies that we used to draw down RSPs with it, withdraw from retained earnings that were trapped in a corporation, so how to shelter assets and pass it on tax-free to the next generation. So we specialize in tax and estate planning, and so
These are all in Canada?
This is Ontario first, so I started in Ontario, but having that designation and having the structure and product knowledge, we started to team up with investment advisors across Canada. So I'm kind of one of these, I think I plateau 5 years or maybe each child as they were born. So the first time we joined with investment advisors, and we were the tax and estate planning arm. When I had the first child and came back, decided to get securities licensed and did the full. So we started to plan what we call wealth management centers. And so kind of built that across Canada. Disruptors in the space, honestly, because at that time, investment brokerage firms had no insurance products, tax products. It wasn't a marriage, each one had their own silo. And so we built what was called integrated financial services, which is not only data aggregator, but having those teams around them. It's almost like your family office structure for the $60 million clients at the bank. We were trying to provide that for the independent brokers. Right?
Wow.
And so that got built, enjoyed that, and when I'm thinking 30 years back, when my niece was born, they took those little webcams and they went back to Zimbabwe, and we used to watch her, and I'm saying, well, if they could do that personally, why can't we do this professionally? So we introduced these video cameras, video conferencing machines in each office across Canada, and that's how our business grew and our brand across Canada.
Oh, wow.
Right? So it was a good business. I don't leave anything when it's down, and we were up and high and working well, but balance is always important to me. Like, to me, family is first, right? So we decided to move to Florida. This is going back 20 years now. And so that was more to focus on the family. So business as usual, at least I thought, because I was doing video conferencing anyways. But having a full securities license, even though my staff was all full securities, could answer all the questions, I had to give up my license after a few years. Right?
Really?
So a few years later, thinking I was coming back, just liked it enough to stay, we decided to sell our business. So we kind of over 2 years weaned off with some of the investment advisors in the office, which is what I teach people anyways, how to buy out your employees or your partners. And so that worked out really well, and timing was right for me. I always call it luck because it's when opportunity and preparedness meet. For me, I sold the business just before the crash, so I didn't have to deal with clients on the market.
Yep.
But I also had the opportunity to buy in the U.S. because I was in Florida, got introduced to the U.S. real estate market.
Oh, you also cash out from your previous business as well.
I had, that's what got me in. So I had the capital to think of something new. And ideally, you would have thought I'd go into stocks and bonds and everything I know, right? Because that was, I'm full-time advising people. But I think what intrigued me about the real estate side was the cash flow monthly in my bank account. It felt like a paycheck. Remember, I had assets under administration that was very large, and so we get what they call trailers. That's a monthly income that you're going to lose when you sell the business. You may have cash, but no monthly cash flow. So the cash flow is what intrigued me, and so we bought our first, I think, 25 condos. I'm always in batches, so it was a batch of condos, and the cash flow was good. Nothing. Felt retired, enjoying the family, but my father's 90 and still today speaking and talking. So I think entrepreneurship is kind of in the family and will probably continue that way. So I started to teach friends and family of what I was doing. And it was really interesting because one thing I noticed even at that time, that mindset shift is really, really important because everything that we were learning and teaching is more like a money mindset. It's like, it's almost consumption oriented. You're working to save, retirement. It's all spending, 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 right? For the first time, I was starting to teach people a cash flow mindset. So I moved from the concept of what's important about money to you to what's important about cash flow to you. And that's simple change. Sometimes it seems like, what's the difference? But the cash flow mindset takes you to a creativity, not instead of a consumption. Right? So as an example, even my kids, they've seen the income. They had assets very young. The cash flow from those assets, they might as well be retired, but they still have good education. They bought their first homes. They're in a creative mode. They won't stop. Whereas with consumption mode, you think, oh, I'm retired, financial security, this financial freedom, I'm done. And you're not done because you can still create. I like to take people through. They say 5 stages of wealth. So the first one is survival. You move to stability. You put your base in place, your emergency fund and insurance, all those things. Great. Move to security. But I think people camp there. They kind of plateau, and I'm saying, well, why stop there? You're secure. You can retire, but you can build success and significance if you kind of think bigger.
Now,
differently.
Hold that thought there. I really like this flow, and I guess one of the biggest challenges that yes, people get to security and they get a peace of mind that hey, they can retire. But the challenge in Ontario specifically, I know you're buying in Florida, but the challenge specifically in Ontario is that people who are getting into the market or just got into market for a few years, they're not seeing the cash flow.
And so there's the key. So for me, I've only experienced positive cash flow. I can't say only experience, myself I've only experienced it. When I first got into the financial service industry, that was in the 90s, MERBs were very popular. So they're multiple unit residential, and they were sold to doctors for what? Negative cash flow, because they were sold as a tax break.
I know, I don't understand. It is real cash flow negative, so I can never understand those.
Well, the idea behind it is take the negative cash flow as deductions today, and over time the mortgage is paying off, and yes, eventually you'll have a property that you can live off the positive cash flow. I get it, but I've never experienced it for myself because I partnered up with a real estate agent. He built a property management business as well to service those clients. And so I ended up going into single family rentals, and I was always taught not only cash flow, but consistent, predictable cash flow. And I was also dealing in the senior market. So monthly regular income was important, not only not negative, but consistency of the pattern has to be there so you can rely on it. So the idea of positive cash flow was just not just natural, but it was the only thing I knew.
That's amazing because I've had so many conversations with people like getting upset at the bank not being able to refinance up to 80% or not able to borrow more money. What they don't understand is that the bank is actually looking at their personal income to qualify, and your income can only be used so many times for so many houses, right? Because their properties do not have the cash flow to justify it. And having said that, they're willing to trade off that cash flow negative cash flow for appreciation. So as you know, like Ontario market has gone up like crazy over the last few years. Maybe not last 2 years in particular, but before that it has gone up straight up, and we're still, I would say we're plateauing and maybe come down a little bit. But the expectation is that as soon as interest rate comes down, then the market is going to take off again because of the demand. Do you feel like you're missing out on something?
So for me, remember I'm a planner, and so I've always taught a balanced portfolio. And so I start with cash flow first, and then I move to appreciation. So I want both, but the cash flow assets help sustain those appreciated assets, right? So I'll give you a quick example. So in 2021, we bought a portfolio, and that portfolio is about 16 properties, good positive cash flow. But again, the trade-off is you're in a different neighborhood, lower, like you've got the ABC classes, right? So, but
wait,
good cash flow.
ABC classes. So A means that they're like really good neighborhood.
Good neighborhood, consistent renter even, like they'll pay on time. In the neighborhoods we were buying, they don't pay on time, but they always pay. Like even during COVID, we got checks from the government for them. The Section 88 is paying for them. So you'll get paid, but it wasn't, this consistency isn't there as well as
so
this.
These are Class C?
I'd say Class C.
Okay.
But those same Class C assets, $1 million is bought. 2 years later, and I'm talking about these last 2 years, right? Because so 2021, March of 2021, March of 2023, we refinanced those assets. But here's the difference. For me, I was used to going to the bank. First, you start on your HELOC, the cheapest rate. Then you go to the bank for the first or second. Those are okay because everyone's willing to give you those. But when you want to buy more, like you said, you're capped with your rental income. Your income. And most self-employed people or tax planners show very little personal income. All our stuff is in trusts and corporations and everything. So to get those type of loans, they're almost like commercial loans here, but they are looking at your cash flow and the asset itself, because they do have to have a certain value. They won't do it on too low, like too small a value. But as a portfolio, what they did, and here's the beauty. This, I call it almost like a critical mass is what we're calling it, where you have enough assets that I'm not even putting $1 of my own money anymore. So what they did is from these 16 properties, we took out 9. Those 9 were the down payment, if you will, and the cash flow from that, plus the 2 we bought in Texas, became the loan. So I'm only borrowing for Texas.
Oh, okay.
But I never put any down payment. But they're looking at the rental property, like you said, the rental income of all those properties, and as long as it can pay after property tax and insurance, they're good with it.
So essentially, you took the portfolio, take the 9 of them, refinance them, and then take that and buy additional 2 properties.
Yes.
Oh, wow.
Yes. So I could still do that with the other 9, but I didn't need that many for the 2 properties I was buying. But the point I'm trying to make is none of that money came out of my pocket. The only thing that came out of our pocket was because of those 16 I had, the cash I had there. They did request us to put an escrow fund together. So you're putting some funds for your future property tax and insurance. But that's not down payment, it's not,
So 16 properties, let's go back to that, because they're Class C properties and they're not always paying on time. There's a larger amount of risk, but it cash flow really well. What's the entry point? Like how much are you, like maybe using that 16 properties as an example, how much cash flow can you generate from this 16 Class C?
So those properties, it's good that you're asking me just now, because we're just going through the motions of seeing the year and how it went. And so I had to kind of split it up, because I had up to March, and then it was June 1st. So up to April, anyways, whatever the dates are. And
things so matter to your only accountant.
So I had this the shift happening in between. But I think it was the new properties. Anyways, it's gross 144,000. So you've got this 144,000 of income coming in, and the taxes. So when you're netting, I'll go with $1 million. The portfolio at that time when we refinanced was 900,000. But even if it was $1 million, that's 14%. Okay. You could afford the interest. You could afford all of it to be able to do those kind of things. So that gives you an idea of what you're getting into.
Yes.
But the other thing I think you said about Ontario and appreciation and all of that, one of the key things is I say stretch the dollar. So what I've always done, because of course now being in real estate in the U.S., when I come to Toronto, everyone's trying to tell me, where they could find me properties over here. So I'm always willing to listen and hear. And so my kids went to Western, so they showed me London. Of course, you're going to obviously pockets outside of Toronto, but I have not seen the numbers in cash flow, like you said.
Yeah.
Right? Appreciation, possibly. But I needed a bit of both. I wasn't used to anything else. Today, I'm willing to go appreciation and break even if I'm borrowing, but that's because I've got cash flow assets to sustain it too. So that's where, to me, diversification comes in too.
Yeah.
You buy a bit of both.
If I may, to summarize your strategy is really cash flow first. Once you hit the critical mass in terms of cash flow, then you can afford to make more aggressive move to invest in something that's more likely to have high appreciation, but still not going into negative cash flow in those properties, but just as a minimum, it has to break even.
It's a backup.
Yeah.
And secondly, I find that when I say, I call it entry level.
Yeah.
That entry level is important too, because some people, it's their first time. They're going across the border. They don't know what this is all about.
Yes.
So keeping it in that entry level market is nice, because it's a sweet spot is what we call it, right?
Awesome, because entry level is what I am at right now. So imagine when you're buying.
Entry level for you, but also entry level to get into single family price points.
So, I mean, we have this slogan that we want to be the Google map for hardworking Canadians.
I like it.
So tell us an example of among the people that you've worked with, if there is someone that's more like everyday Canadian making average Canadian salary.
That didn't have the capital I did to just get started.
Yeah, exactly, because you sound like you just sold the business and then bought a bunch, but then majority of the people cannot afford to buy 16 all at the same time, right? So how you've got someone like that you work with?
Sure, because I mean, everything that you do has to be within even what you were doing now. As a planner, that's always what I'm looking at, right? So I was always used to seeing strategies. So I'll give you a quick example. RSPs. So we have a nurse, she's got a house, regular mortgage. So she's paying principal and interest. And she's putting $6,000 into her RSPs. Something simple. Is that simple enough?
Yeah.
So basically what we did with someone like her, refinance her mortgage to interest only. That in itself gives you more cash flow.
Yeah.
Okay, because now when we went to do the HELOC and increase the mortgage, the whole mortgage was less than what she was paying on her mortgage and interest. So she's still comfortable, right, with her monthly. But now she's got this extra $200,000 that she can go and invest. So that was her starting point. Okay. Her real estate, her real estate has got, she ended up buying 2 properties, but I'll go with one of them. $100,000. Today it's worth $350 odd.
$100 US dollars.
And this is in Florida at the time. Okay. Because of the growth, now she's refinancing and buying another one. But even before the refinance happened, she actually took the income from her property because all these years she was making money, she bought a smaller property in New York, all cash.
Wow.
Right? So reinvesting is also a key part, because when you're building, you've got to think about building first and then thinking about the retirement. Don't think, I've made this money, let's spend, let's use it for, because that spending mentality it's got to, as I said, get into more of this creation mentality.
Yeah, absolutely.
And so she's a good example because not only she was able to keep within her means, but the income from the rental at the beginning, we were actually putting that into her RSP. So she's got a tax break on that. So her tax went down, right? Because you've got her interest on the borrowing for the house. She had that. You've got the RSP deduction. That lump sum she gets back in April. Go put it against the house if you want to pay down any personal portion, because all personal debts I want to pay off.
This I wanted to caution everyone who's listening. This can only happen if you have a cash flowing property. That's the number one key here, right?
Sure.
Otherwise, like in Ontario, it's almost not possible if you invest in Ontario or Southern Ontario, I would say. Like majority of Ontario, you would not be able to achieve that. So
and you have to be cautious, even if it is a cash flow asset, so you could have vacancies. So you have to have, I say, whether you want to call it escrow, you have to have emergency funds even in your own investment portfolio, right? Just in case you have to carry it for a little while.
Yeah, absolutely. So that's a great example. Now, because you're an accountant and I'm an accountant, we're here. on the show, one of the most commonly asked questions is, what kind of tax structure should we be doing when we do investment? Although we are going to do a detailed presentation together on February 29th. So if you haven't signed up, make sure that you sign up in the link below. But what do you see? What do you say to these people who are interested in investing in the US single-family home market?
So structure is always very personal. It's not easy to say, oh, but there's a blanket structure for everyone. What I'm looking at when I'm looking at structure is 3 key areas. The first one's taxation. Tax specialist, that's the first area we're going to look at. Asset protection, another key area, because you are getting into rentals. If it was your second home, no problem, you don't need a structure, you have it in your personal name. But the moment you could have liabilities or someone coming after your assets in Canada or any assets you have, you want to protect that in an entity, right? So of course we're going to have, I like the term earn everything, own nothing, right? So you don't want ownership of anything because you don't want for them to come after your assets you own personally, your home. So that's the first piece that I'd like to say on entity or structure. And then beyond that, you're looking at even estate planning, because in Canada we don't have an estate tax. America has an estate tax. So besides our capital gains on death, they have a tax on top, which they call the estate tax, right? But you have to have over 13 million today.
It's going down though.
That. Yeah, I was going to say anytime it can go down. We can't just, you don't know when. Well, they've been talking about it for a while, so who knows when or if. But still, those are the 3 considerations. And it's not just a state tax. It's planning on death is what I'm going to say. Your capital gains at death, your estate taxes, probate, incapacity, all of that needs to be considered, So those considerations are alleviated, I'll say, when entities are formed. Because sometimes you have formal structures, separate structures, right? You've got separate agreements, let's say, than a will. So, we always talk about second will. Even in the province or the state you're buying the property, you naturally have those things with some of these entity formations, right? So an entity is critical. Which type of entity? Canada, there's only really 2 options. Your corporation or a partnership, right? Because there are other structures in America, but they call them hybrids because they don't have it in Canada. So if they don't have it in Canada, don't go there because you're going to have a mismatch of credits, and you might have double tax. You've got all these other issues. So really there's 2 forms, I would say. And I personally choose one or the other based on the objective of the person. So if they're just going to dabble and try it, don't want to go too fancy. You're going into it for a portfolio and really considering, like I think you're talking about $10,000 a month, getting to this objective of, even for me, it's called financial balance point, where I can replace my income with enough cash flow from assets. If I'm going to go that route, and that's my intention, I'm going to structure it with the proper structure behind it, right?
So do you have, I assume you still have multiple properties in multiple states?
Yes.
So do you have a structure in every single state?
So I actually like 2 ways, and it's actually, the idea came from, in the US they have something called a series LLC. LLCs are not good for Canada, but talk about series LP then. So the idea is, and I could go either way, I'm good with either. I can either have one entity, and I like to have it in a place where it's very protected, good laws that privacy as well as costs, and so I could keep my entity there and foreign register in the various states and to do business, because every state wants their share of tax, and so you have to be authorized to do business in that state. So I can register there to do business and file my state returns if there is tax in those states. The other option is I keep that as like you have a holding company, it's a holding entity, and I build my other state by state underneath it. I prefer that because I find that by the time I have to allocate to each state, I might as well have separate entities holding that, and better bookkeeping, accounting, filing, simple enough.
Yeah, I heard that. Yesterday I was just having a conversation with a US accountant, and she's like, yeah, the client that I was working with has business in all 49 states or something.
Wow.
And then so the client expected everything to be turned around within 2 weeks. It's not possible because just the form alone. Because I guess in Ontario, in Canada, we're lucky enough that we don't have that complication in terms of how you get the tax revenue among all the provinces. We can fill it out all in one form.
And then it's passed on.
But then in the States, you have to file it separately, and it adds up. It adds up, right?
Yeah, I mean, so you do a consolidated federal But you're right, at the state level, you got to do individual and things.
Yeah. So, okay, last question, because we are going on, and I wanted to save some for our February 29th webinar. Last question. I know majority of us, we're new to buying in the States. And because we're new to buying in the States, one of the biggest questions, I see a lot of hoops that I have to jump through. The other question that I have really is, how do we get financing? Because, hey, like, we're foreign national, right? Like, it's not possible for foreign people to buy properties in Canada and get financing. Not a lot of it. So how do we, using that same analogy, we're going outside to get financing. It's not possible. I was just in Costa Rica, and people are saying that it's not possible or very unlikely you would be able to get financing to purchase properties in Costa Rica. You might have some special relationship with special people, then you would be able to get it.
Right.
But it's hard.
Right, and for the longest time, even for me, I struggled. Originally it was cash, but whether it's refinance or purchasing, you always want to use as little of your money and borrow as much as you can when I'm borrowing for investment purposes. Yeah. So you know the rules, but try getting the financing. Yeah. And sometimes even I'll go with even my own children, even worse, right? Because the banks are ready to give you a mortgage on a principal residence, but for investments, it's a whole different ballgame. So initially, it's very difficult to get financing, and then of course you have COVID hit, and even before that, after 2008, all the banks were giving no financing. Forget foreign nationals. So there was this gap of lenders. Today, I mean, even from the first property. You can go into these loans that they have in the U.S. They've got much more variety of loans, let's call it. But the ones that we only see here for commercial, meaning you have to have at least 6 properties, they're doing it on the first property, where they, like you said earlier, they'll look at the cash flow of the property, and if it's got a cash flow to sustain all of the debt service ratios, they will give you that loan. And so the ratio the amount you're going to put down is going to be based on what type of rates do you want. So 25-30% is okay, but the more you put down, the better the rates. So you'll determine what fits you, but very, very easy to get the loans. And that's where I say it's good for self-employed people who don't have income showing up in their tax returns. They still want to see your returns because they want to know you're real and it's you, but they're not using it as a factor in the calculation or the ability to borrow. So financing has been opened up quite a bit. It's just been super, because in the past we could only buy as many as we could based on our income. Today it's not that way at all.
Based on our personal income.
Personal income.
Yeah. Nowadays it's based on the rental income.
Yes. Yes. And so it's opened the doors to so much more planning.
So the sky could be the limit, because as long as, provided that you're buying cash flowing properties that can cover it, then you should be able to buy as many as you
know
want.
What the nice part is? The bank's doing the due diligence. They want to make sure.
That mean?
So they're looking at the properties just as much as you are. So when I go through those, they're going to look at the what the value is. I can't tell them it's worth this. They're going to do appraisals. They're going to look at the cash flow. They're looking at they're not only looking at the rentals in the market if you haven't got it tenanted yet, but most of them will want it tenanted even. They'll want a certain percentage occupancy if you're doing a portfolio. If it's one-off, they'll look at the market rent. So you can't just say, I'm going to make this kind of rents. And you can't. They're looking at the numbers clearly from their angles too, because they're putting up the money. They've got a higher risk than you do. You're putting 20-30% down. They're putting more than you are. They're doing their what we call due diligence. They're looking at it, scrutinizing.
Oh, wow.
So you kind of have second eyes.
Yes, absolutely. So I know we're doing this webinar together on February 29th. Tell us a little bit about SHARE, because we are truly co-hosting this webinar with SHARE, and Carmen is the CFO of SHARE.
I didn't even get to that point in my
career.
So co-founder of SHARE. And really my mission, as well as the company's, is to help. I think that we say the mission is more to make real estate almost as easy as buying mutual funds. It shouldn't be a difficult strategy or transaction, but it has been. And so we want to take away the operational headaches of it all, because in the end, to be able to buy, not only in the U.S., but to buy in any state and to have a portfolio like that, which I like because it kind of helps you diversify. You might not only diversify by states, but higher rents in some, lower in other. You may lose one renter, but you got some on the others. So to be able to do that is not easy. So we've kind of built a platform as asset managers to not only help build a portfolio for you, but I think the key for me, what I liked about it, is we are having institutional contracts. And that's huge because things get on time. They get within budget. We get cheaper insurance. We got lower property management fees. That all of those figures, you know, in accounting, bottom line means we have better cash flow. So, but you always can't do. You can't do alone.
Oh yeah. So does that
on
mean
one property, your first property?
Yes, for sure, 100%. Like, so is it safe to say, summarize it? Correct me if I'm wrong. Is that share with because we're I get questions all the time. Like people ask me what Share does. I know Share is an asset management company, but what does that really mean? Is it safe to say that, hey, with Share, we're leveraging everyone's buying power, essentially grouped together, and we get all these discounts and efficiencies. And Share also help us to manage everything as well. Not just property management, because as we all know, even property managers need management. So on top of that, you talk about insurance, you talk about shopping rates and mortgage qualification. Is it safe to say that Share does all these as well?
Yes, and so we've got contracts across Canada to be able to then pass it on to the investors, right? So we shop, like you said, for all those things. But the other
across U.S.
Across U.S. Sorry. The other side though is also the financial dashboard, because you're really going into a portal where you can see and organize and have things at your fingertip, and you know everything's ready and there. And those, so we'll help you even with entity creation. The forms are in the file, your EIN numbers, everything is organized and easy to see. We'd like to review often enough to see how you're going. Let's use even one example. I've got a property manager. He was doing the rentals. I didn't even look at anything. But the moment we had Share and asset management, all of a sudden we're talking about how much we want the rents to increase by. It wasn't just left up to the property manager. We're discussing, we think it could be this. We upped it, and they were okay with doing that as long as the tenant paid. So we're having discussions about these things on behalf of our investors.
So you're really being a CEO at the high level.
There you go.
And Share is essentially the operation, or like the chief investment officer advising you on everything.
Exactly. Exactly.
Okay.
So
I
we're
like that
finding the assets. So again, that's also personal. So many times I've been asked before co-founding Share, why not just do a REIT? You already have the knowledge, you know the space, you know the markets. The idea of a REIT is joint ownership. I like direct ownership. Not only you have control, you can plan your taxes and this and that. So all of it, I like the direct investment.
Okay, direct investment. That's really good point, because even the U.S. accountant that I was having conversation with, she thought that Share is one of those REIT.
Right, and most people would think that, right? Because it's volume. You're choosing your buy box. When we go in there, we'll do the due diligence, meaning we'll get the inspector in, we'll look at that budget that they're coming up with, we'll go through it with you, see is it reasonable, is it going to give you, is it worth to do for the rental income you're going to get? You'll look at all those numbers again. So all of that's done with you, you know, before and after. And so that's critical, that you've got this person that can help you through with not just answering your questions, but even bringing up things that you might not have thought of.
Wow, that's awesome. So if you guys want to find out more about Share, as well as how to invest in the single-family home market in the US, or even interested in just learning how to generate a $10,000 a monthly passive income portfolio, make sure you sign up for our webinar. Link is below. February 29th is our next webinar. We're hoping, if this one is going to be useful for you guys, we are hoping to do a series of them in the future. But for now, make sure you sign up for the February 29th one. And thank you so much, Carmen.
Oh, you're welcome.
Thank you so much for sharing your insight.
Looking forward to helping.
Yeah, and we will see each other again on 29th, right?
Sounds good.
See you.